Okay, bond issuance. This is when a company is going to issue bonds for maybe the first time. There could be a series of bond issuances over many years, but typically on what is called the primary market, this is where the company here is going to sell bonds initially to a group of investors. These could be institutional investors, individual, other corporations. And that is done in the primary market. And in bond trading, where investors are buying bonds from other investors, this is what's called the secondary market. And this also occurs in the stocks. So the primary market is when the corporation sells initially one time to investors. And then the secondary market is where investors trade amongst themselves. And a classic example of a secondary market is like the New York Stock Exchange. In the New York Stock Exchange, investors are not buying from the corporation, they're buying and selling amongst themselves. So in this slide, we're talking about the initial offering, when the corporation goes ahead and sells the bonds. And so here's the certificate that they're going to be issuing now in electronic format. But the first thing you have to negotiate is the selling price. And what investors look for is on their pricing is, again, the coupon rate and the bond interest payments. So this corporation might issue a bond going out 30 years here. And the bond interest payments typically is paid every 6 months. And that's really what the investor is buying, is these cash flow payments. Now some bond terms. Again, with this chapter, there will be a lot of vocabulary. Do need to study it. So be very careful here. The first term is face value. This is the amount of principal due at maturity date of the bond. Again, bonds are traded usually in increments of $1,000, but you might buy $1 million worth of this bond. Okay, so that's the face value. That's what it will be owed back to you when this bond matures. Now, the price you pay for this bond is going to be three things. You're either going to pay at a discount, at a premium, or the third one is at par value. Par equals 100%. Discount is less than par. Premium is the price over and above par. So, transactions on the maturity date, again, bond face value, these corporations are going to have to buy back from the investors what they borrowed at maturity, whether that be 5, 10, 20, 30 years back. Okay, so that's called the maturity date, or at face value. The face value typically is at 100%. So here's an example of an accounting. So typically in accounting, you're worried about the valuation and the recording of a transaction. And here this company is issuing bonds, and it has a par value of $800,000. The stated interest rate is also known as the coupon rate, and this is what is paying at the end of June, at the end of December, and the maturity is going to be 20 years out. And the journal entry is fairly straightforward. They're receiving cash from the investors, and they now have a bond payable. Sold bonds at par, I would increase more information, for instance, the rate and so forth on there to help, especially if there's more bond offerings coming out. 6 months goes by, and now you have to pay the interest. So it's fairly straightforward in the beginning here. Let me expand this out. There we are. The interest payment is going to be made every 6 months, and you're going to deduct cash, $36,000, and you're going to charge bond interest expense. This will be on your income statement here. This will be your balance sheet transaction. And then typically you're going to put your footnote here. You'll pay semi-annual interest and so forth. Fairly straightforward at this point. It will, like I said, get more complex. Issuing bonds here in December 32, they're now buying back those bonds that they issued 20 years earlier. And again, a reduction of cash from the company and now they're reducing their bonds payable. So fairly easy. This is when you're issuing bonds at par. Here's the problem. Rarely, if ever, well not if ever, but rarely do you ever issue them exactly at par. That's because these market rates change literally by the second or by the minute. So the price can vary. So it's not usually as simple, as clean as it is presented in the academic textbook here. So often you're doing a transaction at a discount or a premium. And there's reasons why for this. You see, when the company usually works with an investment banker to issue the bonds, and there's a lot of work, and that investment banker will give them a pretty good estimate of what maybe that the going market rate is when they expect to deliver. But by the time they lock down that rate, they then usually have to go to the printers and legal to write up all the documentation before they go to market. And again, that price is changing by the minute, by the day. And so rarely will you hit it exactly on this. And so you're going to have to sell it at market rate, not at contract rate. The contract rate is the legal rate. That is what you've been statutorily required to pay. You're going to pay, let's say it's 9% on a bond. That's going to be $90 a year, or $45 every 6 months. But the market rate might say, I want 9.1% or 8.9%. And so what's going to adjust is not the contract rate. That rate is still going to pay $45, but the price of the bond pricing is what fluctuates, not the contract rate. But because the bond price changes and you divide the contract rate by the price, that becomes the market rate. So the market rate will change constantly as the price of the bond changes, but the contract rate does not change. Here we'll give an example of issuing bonds at a discount. This will be where the price of the bond is less. And understand that there's an inversion. If prices go down, interest rates go up. It's sort of like a T-square thing, or like children playing on a balancing beam. So one will have to compensate for the other. And so here the stated interest rate as an example is 8%. But by the time you go to the market, maybe the market moved, and now the market interest rate is 10%. Well, think about this. If the company is offering you 8%, but you can go out and earn 10%, do you really want to buy this 8% bond when you can get 10%? No. So what you're going to do is you're going to discount the price to where the interest rate will now equal that 10%. And here it is. So par value is $100,000. They're issuing $100,000. That's the face amount. That's what's going to have to be paid back to the borrower. But the lender's only giving you $96,454. Here's your discount. So now you're going to mark, here's the cash I received. Here is what I owe. Notice the difference, and this difference is your discount on bonds payable. And the opposite would be true if there was a premium. The premium would be now on this side. And this is a contract liability account. This becomes the challenge. You've got to keep track of this. You've got to be able to calculate this and record this in the right spot. So pay very close attention when you're doing your homework and reading this part of the chapter. Again, they're issuing the bonds. This is the carrying value. This is the maturity value. This is what you have received in cash, but it's going to go up and down in value. And then this discount on the bond, you're going to have to amortize the bond discount, and the same will be true of the premium. You're going to use typically a straight line method, sort of like a depreciation. And amortization is very similar to depreciation in concept, but it just means for bonds or intangibles, whereas depreciation is for a physical good. And so get used to that word, and we'll be on the test. So you're going to discount this amortization for every 6 months. So you're going to divide this 4 periods, and here's what you come out. If this was a 2-year bond, you got 4 periods. If it's a 20-year bond, twice a year, it would be for 40 periods. So you're going to divide that discount by the number of payment periods to get out what you're going to amortize off every pay period. So now you're paying your interest payment as an example. Here's the bond interest rate, and then you have to discount that, and here's what you're paying in cash. So your interest expense is going to add up and include that discount, that your amortization, and the $4,000. Now remember, that $4,000 is the contract rate. Let me go back to an example here. Here, the stated interest rate, i.e. the legal, the contract rate, is 8%. So what is this? This is half that amount because it's paid every 6 months. So they're paying you $4,000 on a $100,000 offering. So they're only paying that 8%, but the discount of the price is what you have to add to your expense, and hence the amortization, and the premium would be on this side. Take your time on this. This can get very, very confusing. You're not going to get this just simply listening to me here. Okay, from there I'm going to stop. We'll do another video.